Good morning, professional colleagues. Welcome to the weekly Saturday knowledge sharing webinar organized by Mehta and Mehta. So today we have our first topic in the NBFC webinars as an introduction to NBFC's concepts and relevance. We have Mr. Keshav Lahoti as our panelist today. Mr. Keshav is a visionary legal and compliance strategist with over 13 years of transformative leadership experience spanning the fintech, NBFC, and manufacturing sectors. He excels at architecting robust compliance frameworks, driving multi-million-dollar capital raises, and adeptly navigating complex regulatory landscapes. Mr. Lahoti is recognized for his ability to foster stakeholder trust, spearhead IPO filings, and effectively resolve high-stakes litigation. He is a collaborative leader who consistently mentors teams to develop excellence and strategically align legal initiatives with broader business growth objectives. He actively participates in industry discussion forums, sharing his insights and engaging in debates, and has received multiple awards and accolades for various projects and accomplishments. His areas of expertise include regulatory compliance. This encompasses RBI guidelines, SEBI LODR, FEMA, FBI digital lending, KYC AML, and DPT-P Act. Corporate governance, he is proficient in board management, ESG compliance, stakeholder engagement, and regulatory audits. Capital markets experience covers IPO, FPO, QIP, debt instruments, private equity, and securitization. He is involved in strategic negotiations, which includes contract drafting, treasury agreements, litigation management, and dispute resolution. We have Mr. Hemant Pandya with us, who has 18 years of rich experience across entire spectrum. His journey began in 2007 with JM Financial Group, where he is currently designated as Executive Director, Compliance, Legal and Corporate Secretary. In the year 2010, to pursue a stint practice, he joined Mehta and Mehta, company secretaries firm, as a partner where he served a diverse range of clients, including listed entities, MNCs, FMCGs, and financial sector institutions. Mr. Pandya holds a Bachelor of Commerce degree and a law degree from University of Mumbai. He is also a qualified company secretary and a fellow member of the Institute of Company Secretaries of India, New Delhi. Currently, Mr. Pandya serves as the Company Secretary and Compliance Officer of JM Financial Limited, the flagship company of JM Financial Group. Additionally, he also oversees compliance and secretarial functions of various subsidiaries in the group, which inter alia includes NBFC and HFC. In his leisure time, Mr. Pandya enjoys reading, drawing, and sketching, as well as writing articles and poetry. He has been an active contributor to ICSI, conducted various programs, training sessions, and has shared his knowledge and expertise with students and professionals, fellow professionals. Welcome to all. We have today with us Ms. Sakshi Gupta, who is an associate member of ICSI and has completed her bachelor's in commerce and law. Previously, she has worked with Multi-Commodity Exchange of India Limited and has experience in the field of incorporation of company, LLPs, increase of capital conducting board and annual general meetings, compliance of SEBI, LODR regulations, SCRA, SEBI prevention, insider trading regulations, etc. We have our own moderator, Mr. Professor R. Balakrishnan, who is a company secretary having almost 4 decades of experience in the secretarial compliances. He has worked with Foteco India Limited and is a regular speaker at ICSI CCI. He regularly contributes in various magazines, including Charter Secretary of ICSI. We welcome you all to this knowledge sharing webinar. So,
I would request we would request Keshav to share his thoughts about the topic, what we are going to discuss.
Thank you, Alicia. Thank you for giving such a long introduction. I'm also considering put my introduction as to give it to some other. So hi everyone. Definitely, it's a privilege to be the part of this session. And hi everyone, good morning. Those who have, as I can see, that there are 134 participants and many people are joining. I hope this would be a very knowledgeable session for every one of them. So just to begin with, just as a disclaimer that whatever views and things I would be sharing over here would be my personal, and nothing is related to my company. And on the session, if I begin, just to let you know about my brief thing. So my experience was always being into the BFSI sector and predominantly in fintech side, and currently heading legal secretarial compliance at RN Financial Solutions Limited, and previously working with Indify Technologies. So these companies are fintech companies, and since theme of the topic is NBFCs challenges and concepts and introduction, so we'll be touching upon the regulatory challenges. So detailed presentation would be there, which will be presented by Sakshi Gupta. I will not be touching on the categorizations or somewhere like what are the nuances, net owned fund, net worth, and all. I would be letting everybody know that what is actually going on. So recently, in my previous stint, I have just completed the RBI audit and sharing you my personal experiences. As you can see that RBI these days, every other company is getting a notice, circular, cease and desist order that you can't do this. If you are doing this, then this is not the manner, and heavy penalties and things are there, prosecutions are there. And the way RBI is actually working, it is a need that as a professional that we should be helping our companies or consulting wherever we are working, just to get out of these problems. So while I will be sharing you with my experience with related to the RBI compliance and recent circulars, penalties which has been imposed on other companies. So between 2023 to 2025, RBI has penalized 62 NBFCs. Just to give you the fact, and just because, and the reasons were largely non-compliance with you can say ranging from what small trivial reason to a large big reasons. You can see Paytm, you can see PhonePe, you can see any other entities wherein large big orders, even Kotak Mahindra Bank, IDFC Bank, every other day you will see that RBI has imposed upon it a penalty, and reasons are almost, you can say, 2-3 reasons, which are predominantly you can say KYCs, fair practice code, and all. So would be touching upon, give you the brief that what are the things I as a professional, and you guys being the company secretary or compliance officer of organization, you should be adhering to. So first one is the violation of KYC norms. UCIC is something which RBI is very particular of, and they are actually emphasizing on using the software. You should having the clear identity of the person, and so that there should not be any chances of any fraud, just to be a proactive measure. RBI is suggesting that you should be having a client identification code. Coming on to the outsourcing guideline, wherein you can see that many of the fintech, earlier we used to have traditional banks and NBFC. Now fintech is there, wherein many of the functions are being discharged by third party. It could be underwriting, it could be audit, it could be verification, field investigations, and everything. So RBI is very particular that to whomsoever you are outsourcing, you should be having a proper rights and obligations imposed on them, and they should also have the audit rights. That is something RBI is very emphatically focusing upon. Third one is reporting to credit bureaus. Now you can see that you will be getting the message that your bureau pull has been done without your consent. If RE, any regulated entity has reported, then some misinformation has been reported, wherein some default categorization and some delay payment and some comments are being given. So RBI is also emphasizing that this should not be happening. So they are coming up with again and again clear instructions, guidelines that you should be doing. You should be updating quarterly, monthly, weekly. Again and again, timelines are being getting revised. Next, interest rate and other charges. See, KFS has been introduced now. Every other product, you can say it is earlier applicable on fintech side, but now it is applicable on other NBFCs as well, that you should be have a standard KFS format, wherein all the charges, all the things, whatever terms and condition, key terms and condition requires to be mentioned. In case it is not mentioned, then you can't come up later on that these conditions were there, and the customer has to pay for it, or customer has to bear the burden. So this is something RBI is coming up with the standard format, and now already been implemented. Again, format revision was there, and again in the coming time you will be seeing that many more changes would be there, considering the product like supply chain, term loan, credit financing, and all other considering the product nature. Then loan documentation and recovery agents, since the main pain point is the customer grievance. RBI has a portal, Sachet portal and the Ombudsman portal, wherein people can see that people are lodging complaints, and the nature of the complaints are one and the same, that the customer agents misbehavior, and they are like calling to their relatives, late night callings and all. So RBI is very much proactive onto this, and they are asking to comply with the fair practice code, because your fair practice code contains the guidelines, contains whatever is required, which is to be done by an NBFC while dealing with the customers. Next is the fraud reporting. Fraud is an integral part, since we are trying to work in that direction, that there should not be any fraud or happening of any fraud, but yeah, it is there. So reporting of fraud on time, that is something which RBI is very particular of, and they came up with the recent master direction wherein you can report the fraud, you need to have a constituted committee. So these things are there. Now the larger part of the this were on the audit side. Now next one is the evergreening of loan. If you can see that RBI came up with the AIF restrictions, wherein AIF can't invest, or your RE can't invest in the AIF, wherein directly relations are there. Largely it's a detailed circular where relations are there. But yeah, on a regulated entities are prohibited from making any investment in the AIF scheme that have a downstream investment either directly or indirectly in the debtor company. That is something RBI is prohibiting, because evergreening of loan is there, money movement is there to repay the loan. The same money is being used to repay and to borrow. Coming on, and recently, if you have seen, RBI has taken a very consumer protection measures, like since with the rise of the digital lending, and significant portion of the NBFCs are retail loans, and RBI has been cognizant of need of the increased consumer protection. So key measures would be like key fact statement, which I have told you, penal circular is there, other directions are there, even SRO concept. This is a new one, wherein RBI has introduced a framework for setting up of SRO for all regulated entities, including NBFCs. And SRO will RBI in adopting this sector to better governance. This is something which is new, and RBI is the only regulator, but I do feel like they came up with innovative ideas, sandbox, if you want to have ideas or do something new. Is it like my connection is stable? I think I can see my screen that my connection is unstable. Sorry if I missed something. Yeah. So this is something which I want that you should be aware of what is actually going in the industry. And while RBI coming up for the audit or having a sense check on what actually you guys are doing, since 1,000 crore limit, whenever your entity is coming onto the middle layer side, so RBI audit will be happening, and they are very vigilant, very particular. Your policies, your KYC things, everything should be a top notch. If you are not able to do anything which you need to supposed to, then you should be having a concrete background for all these things. That is something which I suggest and inform everyone, panelists and the attendees. Yeah, this is from my side. We'll take up the questions, and I can see that in the comment box various questions are being there. But let detailed presentation happen, and then we can take up the question answers for sure. I will let other people to take up from here. And thank you for this opportunity.
Thanks, Keshav. In fact, many of you may be knowing he was there earlier also in our platform. He addressed. It is not the first time he is there actually. He is having such a knowledgeable thing. Of course, during the presentation, he will be sharing his thoughts. I think, Keshav, someone has asked whether we can share your personal detail. If it's so, you can share that also. I would now request Hemant to address on this topic. Your views.
Yeah. Good morning. Am I audible, sir?
Yeah, very much.
Yeah. So sorry, actually, I'm attending from I'm not in Mumbai, and I'm attending from Surat. So I have some network issues, and I've taken my cousin's laptop, so the camera and everything is not clear. But I believe that this works out. No worries.
No problem. We can see you. No problem.
Okay, sir. So 2-3 things from my side. Keshav has covered a lot of things. And very rightly said. The only thing is, I want to cover is, if you compare NBFC regulations with other regulations, like SEBI regulations and all, RBI regulations are not clear. If you see, RBI regulations will not say you'll have to do this, you have to do that. It will just give you, these are the things. You have to understand whether, what actions that you are going to take is going to be in spirit, is it going to be acceptable by regulator, is it proper. Otherwise, RBI may have a different view. So first of the thing is, an RBI regulation is not clear. So how do we understand? It is from our practice. RBI is very clear. You have to be very fair with the customer, as Keshav said. Customers are king for RBI. You have to be very fair with the customers. You have to be very transparent with the customers. Your policies should be very clear. RBI is given 3 lines of defense. First is business, second is compliance and risk functions, and third is internal audit. So RBI is playing a very important role, and it has given a what we say a very good. It has taken a very good initiative for company secretaries, where they have identified chief compliance officers. So chief compliance officers, they said that they are they should have an independent function. They have given a lot of things that chief compliance officers are required to do. Then they are also emphasizing on head of internal audit. They are also emphasizing on CRO. There should be a separate meeting apart from with of the CCO with the audit committee. So there are a lot of things RBI is trying to cover, so that chief compliance officers are playing their role. So today, the topic is introduction. So where we are going to cover a lot of things about NBFCs. I know people would be knowing a lot of things about NBFCs, but this is something for all the company secretaries. If you have not tried in this industry, I will request be in this industry. You will get a lot of good exposure here. So if you get a chance working in an NBFC, and that too an active NBFC, I think it's something, lot of things to learn here. And RBI audit, during RBI audit, the RBI thoughts, it's something which when we discuss with them, we come to know, RBI is thinking in this fashion. We thought in this fashion, but RBI is thinking in this way. So it's something which is always learning. And as Keshav said, I have one disclaimer, which the thoughts that I'm sharing is nothing from my company side. It is all my personal views. So that's it, sir.
Thanks a lot, Hemant. But if you have heard whatever the panelist has shared, it shows what is the importance of RBI regulation, what is the role the company secretaries has to play. That is very, very clear, number one. And number two is, since it is the introductory section of the NBFC, we must also know NBFC is actually more or less supplementing the function of the bank. NBFC can do everything other than the banking activities. That is the thing, NBFC, when we talk about it. Because NBFC today is contributing a lot of things in financial services sector, right from loan, advances, hire purchase, leasing, even on the buying of securities, even investing in the government securities, marketable securities, so many things which are actually there. And another thing is there, this is a very, very fast growing industry which is happening. If you ever see the statistics, etc., you might see the last 2 decades, maybe going back to 2000, the NPS is actually total asset under management, which was actually there about 2 trillion in India, which is almost grown to something closer to 43 trillion in the year 2024, as per the statistics which are actually available. So now what happens is there are a lot of NBFC companies which are actually there. Many of you may be knowing it. There's a Birla Global, there's a LIC housing company. People who are south, they'll be knowing what you call Bukut Fincam, Sriram Finance, and even Edelweiss. All these things are all leading financial sector services which are actually there. But at the same time, Keshav and Hemant also said, there have been also failure of the NBFCs. Many of you may be knowing very recently that IL&FS and also what you call Diwan Housing. These are all some of the glaring examples which actually came. So NBFC has been growing annually around 12% growth consistently compared with the banks. Outpacking the banks, rather, I would say actually, this is a very, very important sector. Another thing is there, Keshav, we touched upon the various regulation. RBI is coming back regularly. I also happen to work with the NBFC companies. One thing is very clear. RBI is very quick. Any problem you refer to them, you will get an immediate response. That is number one. Anything you submit, they will come back very immediately. And similarly, any issues also, they will take immediately. They expect the fastly, you'll have to resolve, you'll have to respond. That is the way it is actually there. Anyway, today, Sakshi is going to take us the preliminary things about the concept, about the introduction, things, etc. As we go along, you can put up your questions and you can seek your clarification. The chat box will be taking it. I'm really overwhelmed to see the number of participants, which is actually over 225 plus, which are actually there, which show the importance of this particular topic. Okay, over to Sakshi, your presentations.
So I would like to inform everyone today's webinar is the first in the series of NBFC webinars that will be conducted by Mehta and Mehta over the next few weeks. So kindly be with us in this journey of NBFC compliances. Thank you. Sakshi can begin the presentation.
Thank you. So good morning, everyone. So today's our first session on the NBFCs is an introduction to NBFCs, the concepts and relevance. It's going to be a very basic session as compared to what everybody and the panelist has said. But I think it's very important to understand it, the NBFCs from the basics, and then we'll go further in the deep nitty-gritties of NBFCs in the going forward sessions. So in today's session, what we are going to cover is the introduction to NBFCs, like what are NBFC, their definitions, inclusions, non-inclusions, then its classifications, how and where, in RBI has classified NBFCs on the basis of their asset size, scale, liabilities. So we'll be discussing all of that. And then in a very short, I would say we'll be discussing the difference between a bank and an NBFC. Then we'll go for the governance guidelines, which has been given in the scale-based regulations issued by RBI. So we'll be discussing the guidelines for the NBFC's base layer, which will be applicable for middle layer and upper layer both. And then the additional guidelines, which would be applicable for middle layer and the upper layer both. And then the governance guidelines, which will be applicable for upper layer only. After that, we'll be discussing about the statutory auditors in the NBFCs, because RBI has come up with the requirements of having different number of auditors in the different NBFCs depending on their sizes. And then we'll be discussing one case law, identifying and giving details about the importance of the NBFCs. And then we'll take up your question answers. So just to start with, NBFC is a non-banking financial company, and they are the companies which are registered with the Companies Act. And after registering with the under Companies Act, they get a license or a registration with RBI. NBFCs are like the financial institution. They offer loans and other financial services, but they are not the banks. They play a significant role in financial system, especially in the areas where traditional banking may not be accessible. And they play a crucial role in broadening access to the financial services. They are recognized as a complementary to the banking system, capable of absorbing shocks and spreading risk at times of financial distress. And they played an important role in Indian financial system by complementing and competing with banks and by bringing in efficiency and diversity into the financial intermediation. They have evolved considerably in terms of operations, heterogeneity, asset quality and profitability, and regulatory architecture. Going forward, the growing systematic importance and interconnectedness of this sector calls for a regulatory vigil. RBI is already very active, and going forward, we'll see more stringent provisions. Now, to understand what is NBFC, so it has been described under Section 45I, subsection F of RBI Act 1934. They say that NBFC is a financial institution, which is a company. As we discussed, it has to be a company which is registered under a Companies Act, and a non-banking institution, which is again a company and has its principal business, the receiving of deposits, and under any scheme of arrangement or in any other manner, or lending in any manner. And any other non-banking institution or class of such institutions as the bank may, with the previous approval of central government and notification in the official gazette specifically. Then the Section 45I subsection C of RBI Act 1934 defines what is a financial institution. Because to understand what is NBFC, first we need to understand a financial institution, because it includes any activity of making loans and advances, acquisition of shares, stocks, bonds, debentures, securities issued by government or other marketable securities, letting, delivering of goods to hirer under hire purchase agreement, carrying on any class of insurance business, or check business or accepting public deposit under any scheme and arrangement will be included in the financial services, and the organization giving such services would be the financial institutions, would be considered in NBFCs. However, such other institutions whose principal business is of any agricultural activity, industrial activity, purchase or sale of any goods other than the securities, or providing any services and sale, purchase, constructions of immovable property would not be considered as a financial institution and accordingly will not be covered as NBFCs. Now we understood that they are the NBFCs engage in the financial activities of lending, investments, and other related services, but are not the traditional banks. But when a company is registered under a Companies Act, initially to understand if they are getting into the, they have to get themselves registered with the RBI for the NBFC license. So first they need to have, qualify a 50-50 test. So under that 50-50 test, companies' financial assets shall constitute more than 50% of the total assets, and the income from those financial assets shall be more than 50% of the gross income of that company. If both of these requirements are qualified, and then the company can qualify to become an NBFC. Once this test is completed, then only a company can apply to RBI for the registration as an NBFC. After that, there are separate other requirements which needs to be carry forwarded. So once the 50-50 test is done, then NBFC can carry on the business. First, they have to have obtain a license, certificate of registration from the RBI, and have a minimum net owned funds. So net owned funds has been given by RBI different for the different NBFCs. A different net owned fund requirements have been given by RBI, which has now been restricted to minimum at least rupees 10 crores. Higher amount has been given for the different kind of NBFC. Now there are some other kind of institutions which does the work like NBFCs, but because they have different regulators, they are exempted from the requirement of registration as with RBI. So they are not required to have a separate registration from RBI. But if required, if there is any circular or any master direction, they have to follow those guidelines. So that includes venture capital fund, merchant banking companies, stockbroking companies as registered with SEBI, insurance companies which are registered with IRDA, Nidhi companies as notified under Companies Act 2013, chit companies and as defined in Chit Funds Act 1982, housing finance companies regulated by NHB, and stock exchange or a mutual benefit company. Then to understand,
actually, I want to add one thing here.
Sure.
With respect to HFC, can you go on this slide?
Yeah.
So HFC is also regulated, though regulated by NHB, but HFC is also regulated by RBI guidelines, where they have to follow the scale-based regulations, and it falls in the middle layer NBFC. So
yeah.
HFC is regulated by both NHB as well as RBI.
Someone is actually asking, any insurance business company will be also considered as a NBFC under section 45 1F of the Act.
So, sir, it is already an NBFC, but because it is registered with IRDA, it does not require a separate registration with RBI. However, if there is any master direction requirements, even if in the SBR, it is written that the insurance companies are also required to follow these guidelines, they have to follow such guidelines.
Yeah, they have to fulfill the eligibility criteria. That is the main thing which is actually there in the RBI, if I'm not mistaken. Yeah, go ahead.
Yeah. So, in the definition, we understood that it has to have a principal business for the qualifying for the 50-50 test. So, principal business is a prerequisite for a NBFC registration, and that principal business has to be a financial activity. As we have already discussed, the financial activities includes the lending, insurance, acquisition of securities. All those financial activities has to be the principal business of the NBFC to get itself registered with the RBI as a NBFC. Then to understand what is net owned funds or NOF. So NOF is basically the capital owned by the NBFC. However, there are certain deductions which has been given in the scale-based regulations in detail, which are the certain liabilities. So this is how the net owned fund would be calculated, the paid up capital and free reserves, subject to certain deductions of the liabilities. The minimum NOF in the NBFC is required by RBI is rupees 10 crores. But for the existing NBFCs, the deadline is March 31st, 2027 to come to the NOF of rupees 10 crores. However, the new NBFCs are required to have the minimum NOF of 10 crores. And minimum NOF could be higher for the other NBFCs depending on their specific types. Now to understand the basic difference between a bank and an NBFC. So as we have discussed, NBFC is a company that provides banking services without holding a banking license. They are also into lending. So it's kind of a bank kind of a work, but it does not hold a bank license. However, bank is a government authorized financial intermediary that aims at providing banking services to the general public. NBFCs are incorporated under Companies Act 2013 or any other previous company law, and then they get themselves registered with RBI as an NBFC. However, banks are not required to get themselves registered under Companies Act. They are registered under a Banking Regulation Act 1949.
Absolutely, you are right actually. Because banks, when you are establishing, it is directly governed under the Banking Regulation Act of 1940. That is very clear. And similarly, the banks, which they get into the capital market, that means they want to get listed, as we have seen many banks which are there actually in the listed market. Then what they'll have to do is they'll have to not get registered or something like that, but they'll have to comply with the requirement which are relating to the market-related activities under the Companies Act and as well as SEBI LODR regulation. They'll have to comply with that only to the extent market-related activity like IPO, FPO, dividend distribution, security, buying, selling, transfer, demat, all those things, they'll have to comply with it. That is as per the bank is concerned. But when it's come to the NBFC are concerned, as you rightly said, these are basically companies incorporated under the Companies Act. Whether it can be a private company, whether it can be a public company, whatever it is, all companies can be registered. But once you register, then depending upon the criteria, etc., and all this thing, you have to apply to the RBI, get a license granted for NBFC activities to be conducted. That is the crux of the matter. One more thing is there, I think Sakshi is actually covering. Even if it is a private company which is registered under the banking regulations and getting the license as a NBFC, although private companies are not required to set up the audit committee, nomination, evaluation committee, risk management committee, etc., per se under the Companies Act, but RBI regulation calls for these committees for all NBFC companies, irrespective of private or public. In such a case, RBI Master Circular is very, very clear. They need to have the audit committee, they need to have the nomination committee, they need to have the risk management committee, asset liability management committee, etc., and all the things. All these committees will be actually governed exactly under the provision of Companies Act, that is Section 177, Section 178, etc. They have to comply with it. So this will have to be very clear on that. That is what I just wanted to give. Yeah, go ahead, Sach.
So the NBFCs cannot accept demand deposits. However, banks accept demand deposits. And the payment and settlement systems are not part of NBFCs and they cannot issue checks drawn on itself. For the bank, it is the integral part of the system. The reserve ratios are not required to be maintained in the NBFCs, wherein it is compulsory for the banks to maintain the reserve ratios. The deposit insurance facility is not available with the NBFCs, which has been available with the banks. And the transaction services are not provided by NBFCs, which are provided by the banks. So this is a basic understanding how it has been differed from each other, NBFCs and the banks. Now we'll move to the second topic of our presentation, which is a classification of NBFCs. So RBI has classified NBFCs into different parts. The first is based on the liability. So as per the liability, deposit-taking NBFCs so RBI has classified it into two parts: deposit-taking and non-deposit-taking NBFCs. So deposit-takings are NBFCs are those NBFCs which are authorized to accept and hold deposits. And since they hold public deposits, they play a vital role in mobilizing savings from public and channeling them into various financial products and services. Then there are non-deposit taking NBFCs. They are not authorized to accept public deposits, and their sources of funds primarily includes borrowings, debentures, and other financial instruments. And they provide credit and other financial services, but do not engage in the deposit-taking activities. Then, basis on the asset size, the RBI has classified NBFCs into systematically important NBFCs, non-deposit taking, and systematic and non-systematically important NBFCs. Sorry, there's some typo error. So systematically important NBFC is a NBFC which does not accept whole public deposit and have total assets of rupees 500 crore and above, as shown in their last audited balance sheets. They're also subject to stricter regulatory norms and enhanced supervisions due to their potential impact on the overall financial stability. Then non-systematic important NBFCs are those NBFCs, they have relatively smaller asset base and are categorized as non-systematically important. And they're subject to less stringent regulatory framework as compared to systematically important counterparts. Then there are RBI has classified NBFCs based on their nature of business, as we can say based on their activities. First comes as Asset Finance Company, AFC, which is also called as NBFC, Investment and Credit Company. So asset finance companies are generally part of, they finance physical assets, including automobiles, tractors, and generators. Then there's a loan company, which is again a part of investment and a credit NBFC. They provide finance by making loans or advances. Then investment company, it is in the acquisition of securities for purpose of selling. Then there is NBFC Infrastructure Finance Company, NBFC IFC, which provides only infrastructure loans. But there's a requirement that minimum 75% of total assets shall be deployed in the infrastructure loans only. Then only a NBFC would be considered as a NBFC in Infrastructure Finance Company. And it has a NOF of minimum NOF requirement of 300 crore or above. Then there is NBFC Systematically Important Core Investment Company, which is CIC. So CIC is that kind of NBFC which is into the group companies, and they make investments and loans to the group companies only. So for the CIC, it is allowed that they can make investment in the bank deposits, money market instruments, money market and mutual funds, liquid mutual funds, or government securities, bonds, debentures issued by the group companies only. They can grant loans to their group companies, issue guarantees on behalf of group companies. And then 90% of assets shall be in the form of investment in equity, preference shares, bonds, debentures only. Then only it would be considered as a CIC. Then Infrastructure Debt Fund NBFC. It facilitates flow of long-term debt into infrastructure projects. Again, it is kind of a different kind of an infrastructure finance company, which is into debt fund. So it would be a non-deposit taking NBFC, and it also has a minimum NOF requirement of rupees 300 crore or more. And it invests only in public-private partnerships, which we call as PPP model. Then we have microfinance institutions, which we all know, MFIs. They extend credits to economically disadvantaged groups, and their ticket size is generally very low. Then there is other category called NBFC factor, which is in the acquisition of receivables or an assigner or extending loans against the security interest of the receivables at a discount. Then the NBFC non-operative financial holding company, NOFHC, which is in the facilitation of promoters, promoter groups in setting up new banks. Then mortgage guarantee company, MGC and NBFC, which undertakes mortgage guarantee business only. NBFC account aggregator. It collects and provides information about a customer's financial assets in consolidated, organized, and retrievable manner to the customer or the others as specified by the customer. Then peer-to-peer lending platform NBFC, P2P. It provides an online platform to bring leaders and borrowers together to help mobilize funds. And standalone primary dealers NBFC, it deals in buying and selling of government securities. Most of these PDs are subsidiaries of scheduled commercial banks established as NBFCs. So all these classifications were by the RBI on the nature of business liability, and then in the scale-based regulations, RBI has given a regulatory structure to the NBFCs, and they are comprising of the layers based on their size, activity, and perceived riskiness. So irrespective of their activities, whatever it is, they have to be classified into the layers as well. First is base layer, middle layer, upper layer, and the top layer. So we'll go to these layers one by one. First is the base layer NBFC. So base layer NBFC has to be the non-deposit taking NBFC below the asset size of 1,000 crore. So any NBFC which is into any kind of activity has the asset size of rupees less than 1,000 crores will be considered under the base layer NBFC. However, there is an exception to that as well. If NBFC, there are 4 types of NBFC, irrespective of their asset size, will always be considered as a base layer NBFC, which is peer-to-peer lending platform, account and aggregator NBFC, non-operative financial holding company, and NBFC not availing public funds and not having any customer interface. Then we have middle layer NBFC. So all deposit taking NBFC, irrespective of their asset size, will be considered under the middle layer. Non-deposit taking NBFC with the asset size of rupees 1,000 crore or more will be considered in the middle layer. And NBFCs, there are also certain NBFC on the basis of their activities, wherein irrespective of their asset size, they will always be considered in the middle layer, which is standalone primary dealer NBFC, infrastructure debt fund, non-banking financial company, core investment company, housing finance company, and an NBFC infrastructure finance company. So all these NBFCs, irrespective of their asset size, will always be considered in the middle layer. So for these layers, first thing we need to understand is why RBI has given these NBFCs into layering is because they have, according to their layers, the regulatory norms are getting stringent. So for the base layer NBFCs, there are certain regulations which needs to be followed by those NBFCs. The moment they move to the middle layer, the regulatory norms get stringent. For the upper layer, it gets more stringent, and this is how it works. So for the upper layer NBFCs, it will comprise of those NBFCs which are specifically identified by the RBI as warranting enhanced regulatory requirement based on the set parameters and scoring methodology. The top 10 eligible NBFC in terms of their asset size shall always reside in the upper layer, irrespective of any other factor. So for deciding in the upper layer, the power is with the RBI. Then there is a 4th layer, which is a top layer, but it generally remains empty and get populated only if RBI is of the opinion that there is a substantial increase in the potential systematic risk from specific NBFCs in the upper layer. So the stringent norms would be followed by the top layer NBFCs. Now there's one more thing. If there's multiple NBFCs in a group, they are classified differently. So they are not classified on the basis of their standalone asset size. So generally they are classified in the middle layer irrespective of their asset size, and they are classified on the basis of the consolidated asset size.
You touched upon the very good point actually here. In fact, there are many group companies. What they do, because they give the intercompany investments. So what they do is, or normally they establish the NBFCs according to the need. As you rightly say, there are number of NBFCs are there within a group. NBFCs will be there only for the investment purpose. NBFC company for only, investing in the group companies, etc. Other thing and all. Like that, there are various NBFCs are there. So as you rightly say, whether each NBFC has to be identified or the group is to be identified, what is the criteria? That's a very good point you brought out actually. Hemant, anything you would like to share on this?
Yes, sir. What you said is correct. There are various companies, which various group having, a lot of NBFCs in the group. In JM Financial, we have 5 NBFCs, sir. So 3 NBFCs are purely investment NBFCs. 2 NBFCs are into lending. Even in one NBFC, is specifically for real estate lending, and we also have an HFC. So when you say multiple NBFCs in the group, all the asset size are combined together, and if it is more than 1,000 crore, then we have to follow the guidelines as if you are middle layer NBFC. Everyone is a middle layer NBFC. RBI has, sir, in October 2022, if I'm not wrong, RBI had, come out with a very nice circular, October 11, 2022, explaining, multiple NBFCs in the group. It has given, a example where there are 7 NBFCs in the group, and how do you classify, which NBFCs will fall under middle layer, what will fall under base layer, and how it is to be calculated. So I'll request all the participants to go through that circular if you can. It's October 11, 2022. You will come to clearly understand this very well. It has, they have given it very categorically. If you allow, can I read this? Here?
Yeah, sure.
Yeah. So it says there is a situation given. There are 7 NBFCs in a group. One is an investment and credit company with an asset size of 300 crore, a HFC with an asset size of 300 crore, an infrastructure finance company with an asset size of 500 crore, a microfinance institution with an asset size of 100 crore, an NBFC peer-to-peer lending with an asset size of 50 crore, and an NBFC without public funds and customer interface with an asset size of 70 crore. How will these NBFCs be classified in various layers? So RBI is giving the answer to it. On a standalone basis, as per SBI regulatory framework, HFCs and IFCs will by default be included in the middle layer, but may move to the upper layer based on the supervisory filtering process. So for HFC, you don't require 1,000 crore and all. If it is an HFC, you are a middle layer NBFC. Then for NBFC ICC and NBFC MFI will be classified in base layer as their asset size is less than 1,000 crore. An NBFC P2P and NBFC without public funds and customer interface will by default be included in base layer. But if you consolidate, now RBI is saying, based on the consolidation of all the NBFCs in the group, the consolidated asset size of the group becomes 1,320 crore, which is higher than the threshold of 1,000 crore. As such, NBFC ICC and NBFC MFI will be classified in the middle layer. Earlier it was a base layer, but now it will be classified as middle layer. HFC and IFC will continue to be classified as middle layer. However, NBFC P2P and NBFC without public funds and customer interface will continue to be classified as base layer. So RBI is very categorically told that if it is a NBFC without public funds and customer interface. I'll also like to add one thing here. RBI is also classifying, sir, NBFCs in further 2 categories: Type 1 NBFC and Type 2 NBFCs. So Type 1 NBFCs are NBFCs without public funds and customer interface. So those are Type 1 NBFCs, and Type 2 NBFCs are vice versa, with customer interface and public deposits, public funds. So
Hemant, that classification would be required at a time of registration. I think that classification is while applying for the RBI license, you need to categorize like this. Largely, this is on a larger base key, whether the NBFC wants to be in deposit taking or non-deposit taking. Then I think Type 1, Type 2 is coming into the picture.
Yeah.
Do the RBI also has got some sort of the limitation on the NBFC that we know you're having too many NBFCs in the group. You need to
Correct.
restrict yourself so many. Is there anything like that in the RBI?
Yes, sir. So RBI is, off late, stopped giving license to people, companies, if there are more than one or two NBFCs, unless, it is required, they will not give a license. And they have further approached many groups, to consolidate their NBFCs and reduce the NBFCs in the group. So that is what RBI started that.
Absolutely, you are right actually, because that is also my experience. I was actually working in one of the group companies where they have almost about 6 NPSs. RBI one day they came back very clearly said that you are having too many NPSs. There is a need for you to reduce your number of NPSs. That is what they actually came up. And ultimately the company has gone to the merger and amalgamations and they formulated the scheme. And then they got to merge, they reduced their number of NPSs. That is why I asked this question actually. Yeah.
Yes, actually, and RBI is not allowing layering of NBFCs nowadays.
Yeah, that is right. Which used to be there earlier. People used to open left and right the NBFCs companies. Later they found out and they are actually restricting themselves now. Yeah.
Yeah.
Go ahead.
Okay. Then now we'll understand the governance guidelines for NBFCs, base layers. So these guidelines are applicable on all NBFCs, irrespective of their sizes, whether it's base, middle, or upper layer. So first, to have an experience on the board. So because as we have discussed earlier, NBFCs could be any companies, be it public or private companies, and generally private companies does not have a very experienced or a diverse board. So RBI has mandated for the NBFCs and for the effective management that at least one of the director on the board of an NBFC shall have a relevant professional experience, and that experience should include having worked in a bank or an NBFC. So it is a very specific experience which is required for an NBFC's board now. Then NBFCs are required to constitute a risk management committee. So as per Companies Act, risk management committee is not applicable for the private limited entities. However, if those private limited companies are NBFC, they are required to constitute RMC committee. And because for the NBFCs, risk management is the priority, and they are required to establish the committee at the board, and they can also establish that committee at executive level as well. And that committee will be responsible for assessing the overall risk faced by the NBFC, including its liquidity risk, and any findings that the committee finds out, it should be reported to the board.
Sakshi,
yes, sir.
You touch upon base layer, middle layer, and top layer, etc. Now all these committees will be applicable irrespective of any layer which is concerned, so long as you are an NBFC company.
No, sir. So for the base layer NBFCs, only RMC is applicable.
Okay.
So that covers all the NBFCs, the middle layer, upper layer.
I'm talking about the RMC. Yeah, I'm talking about the RMC.
RMC is applicable on all the NBFCs. So the governance guidelines, which is applicable on base layer, are required to be followed by middle layer, upper layer, and all.
Correct.
Yeah.
Yeah, go ahead.
Then there is a requirement which is been given in the scale-based regulations by the RBI, which includes the loans to directors, senior officers, and relatives of the directors. So RBI has put up stringent regulations on the same, that NBFCs are required to put in place a board-approved policy, which will be specifying a threshold to give the loans to directors, senior officers, or relatives of the directors, and entities in which directors or their relatives have a major shareholding. So if any amount has been given as a loan beyond that particular threshold, then that is required to be reported to the board of directors of the company. However, there is a requirement that directors cannot be given more than 5 crores loans. It has been given in the SBR.
So here they say if it is more than 5 crores and if a loan is to be given, then that has to be approved by the committee or by the board of directors. Then only it can be given. Otherwise, if it is below the threshold of 5 crore, or as may be decided by the policy, then the sanctioning authority can give the loan. But for more than 5 crores, it has to be done through a board or a committee.
Yeah, normally what happens is the committee examine the things and they recommend to the board, and the board takes into the consideration. The sanction is normally given. That is the way it works. Yeah.
Then with respect to these loans, there are certain disclosures which are required to be given. So in the annual financial statements, the disclosures with respect to the aggregate amount of loans outstanding at the end of financial year has to be given. Percentage of that loans in relation to the total loan portfolio, a comparative percentage is required to be given. And any instances of default or delay in repayment pertaining to these loans is also required to be disclosed in the annual financial statements. Along with that, the proper bifurcation of the loans given to the directors, their relatives, and entities associated with those directors and their relatives, and any other senior officers and their relatives. If the loan has been given to any of those people, proper bifurcation should be given in those financial statements, and a proper comparison stating the loan given in the current year and as compared to previous year. That needs to be disclosed in the annual financial statements. Now we'll be discussing about the acquisition and transfer of control of NBFCs. This is a very important topic because it says that the RBI's prior approval is required for the takeover or acquisition of control of NBFC with or without change in management. So there are two different things in that. First is a change in shareholding. If there's a change in shareholding of RBI resulting in acquisition or transfer of 26% or more of the shareholding, then before completing that particular transfer or acquisition, they need to require a prior RBI's approval if that particular change is going to the resulting in 26% or more. However, there is an exception to that. If it is exceeding 26% due to buyback reduction of capital approved by the competent court, then prior approval is not required. However, you need to intimate RBI with respect to the same within 1 month. Then there is the other requirement of the prior approval from RBI is the change in management. If that particular change results in the change of more than 30% of the total directors, then a prior RBI's approval is required for that. However, it is not applicable on the independent directors. They can be excluded. And if there is a reappointment of the directors on retirement by rotation, then prior approval is not required. And in the ongoing reporting obligation, NBFCs are required to inform RBI with respect to any change in directors or management, even if there is no prior approval is there. So because when it is not, it is less than 26%, you have to still intimate RBI, but it would be a reporting. But for prior approval, for this 26% or more, or 30% prior approval is there. Also, there is one more point. It is not a one-time approval. Like if you're doing a change today, it is only that is constituting as a 26%. If there's a change today, then tomorrow, a month later or however it is, since first approval to the next approval, if the complete changes, consolidated changes more than 26% or 30%, then the prior approval would be required. It is not on a standalone basis.
That means every change you need a prior approval. It is not that you have taken the
every change, but if today a company takes a prior approval and after that four transactions happens on a standalone basis, it is not a 26%, but on a consolidation basis, the fifth change is going in the 26% or 30%, as the case may be. It needs a prior approval. On a consolidated basis needs to be checked.
Yeah.
Then for the prior approval or acquisition of transfer of control, the application is required to be submitted to RBI, wherein the NBFC shall apply on the company's letterhead to RBI's regional office where registered office is located, along with the details of the proposed directors or the shareholders as given in the Annexure 12 of the scale-based regulations, and the sources of funds of those proposed shareholders. And along with that particular application or declaration with respect to the declaration confirming that they are not associated with any unincorporated body accepting public deposits. They're not linked to any companies whose certificate of registration application was rejected by RBI. And there are no criminal cases included under Section 138 of NI Act. Along with that, a banker's report on proposed directors, shareholders is also required to be given. So the requirement of prior public notice about change in control or management is, so the NBFCs are required to give a public notice at least of at least 30 days before effecting any sale or transfer of ownership or control with or without share sale. And this notice must be given after RBI's prior approval by the NBFC. So after the approval, a 30 days notice would be given, and then the transaction would be completed. The notice shall include the details with respect to the intention to either sell or transfer of ownership or control, details of the transferee, and reason for which the transaction is happening. And the publication is required to be given in one leading national newspaper and one leading local vernacular newspaper wherein the NBFC's registered office is located. And in the vernacular newspaper, as we always say, it has to be given in the vernacular language only. English will not be accepted.
Here, I would like to share one practical example, which I recently found out. If your NBFC is a listed NBFC, and you because this acquisition all are required to be disclosed to the stock exchange under Regulation 30, and if you have made that disclosure, you can go and request RBI for waiving of this 30 days to some lesser period. And RBI has recently given for many companies, they waived the 30 days requirement because it is already in the public domain. So that's a thing which something RBI is also considering, that if it is publicly disclosed, then you don't have to make 30 days, you don't have to wait for 30 days. So in one of the case, I found out that they have given a waiver and they had asked only 7 days notice.
Very useful information. Very useful information. Yeah.
So the other requirement is the investment from FATF non-compliant jurisdictions. So to understand this, Financial Action Task Force identifies the jurisdictions with weak measures to combat money laundering and terrorist financing. It issues that list 3 times a year. So what NBFCs are required to do is, if there is any investments from any organization which falls in the list of FATF non-compliant jurisdiction, then if there is a new investment, they are not treated with the at par with the compliant ones. So the new investors from such jurisdictions cannot acquire significant influence, and the aggregate holding, either directly or indirectly, must be less than 20% of the total voting power, including potential voting rights. If there are existing investors who are from a FATF non-compliant jurisdictions and they hold those shares before classification as a non-compliant, then they can continue holding holding their existing shareholdings and bring in the additional investments as per the regulations to support business continuity, but they cannot go beyond the threshold. So here it is very important from the compliance perspective, that that the companies are required to be vigilant about that particular list issued by FATF and keep a thorough check of the investments made by the those companies in the NBFC. So I mean, accordingly, a proper internal, either an SOP or a proper processes need to be followed by the NBFCs. And it's not a one-time activity. They have to keep on doing it around the year to understand if there are any investments from a FATF non-compliant jurisdictions, because the list keeps on changing. So it cannot be based on the single list. So that is very important, that the companies are required to do the due diligence of the investors as well, before accepting any investments from the investors, and after accepting investment as well, they need to keep on doing that particular check. So NBFCs are required.
Sakshi,
Yes, sir.
when you are saying this, what you call the FATF, whether they are moved anything except or not the same, whether there is any periodical notification list is being published and where it is accessible, any idea?
So it is on their official website, sir. They issue that particular list 3 times a year, and RBI says that we cannot accept investments, or if we do accept, it has to be within the limits from a FATF non-compliant jurisdiction. It is
Okay,
just to avoid the money laundering or
So that
terrorist
means-
financing.
So that means regularly they are actually updating this list. Lists are available on the website
Yes, sir, 3 times a year.
3 times. Okay,
So that's
thank you.
why companies are required to keep on doing the check and have to have a SOP internally to understand, I mean, if there is any change. So if there is any closure of any branch, NBFCs are required to issue a public notice at least 3 months before closing any branch or office. And the publication requires to be given in the one leading newspaper and one leading local vernacular newspaper covering that particular branch office location. And the location, that particular notice must specify the purpose of the closure and arrangements made for servicing depositors and other stakeholders. If there is any change of address, directors, auditors, and the principal office, it must be informed to RBI regional office within 1 month of any change in the following. If there is any change in the registered or corporate office, then the address, phone numbers, and the fax numbers should be intimated to RBI within 1 month of that change. Name and residential address of the directors, if there is any change in that, in the residential address of the directors as well, if there is any change, same needs to be intimated to RBI. If names and designations of the principal officers, if there is any change in the name and designation, then needs to be intimated to RBI. If the office or the name of the auditor has been changed, then same is also required to be intimated to RBI. And the specimen signatures of the authorized signatories are changed, then same also needs to be intimated to RBI within 1 month of that particular change. Now the governance guidelines for NBFC's middle layers, which would be the additional guidelines from the base layers. So NBFCs in the middle layers are subject to stringent guidelines as compared to base layer NBFCs. So whatever we have discussed for the base layers are required to be followed by NBFCs in the middle layer. Along with that, these guidelines are required to be also followed by the NBFCs in the middle layer or the upper layer as given in the scale-based regulations. So NBFCs in the middle layer are required to constitute various committees of the board, irrespective of the fact that if it has been applicable from the other laws or not. First is the Asset Liability Management Committee, then Audit Committee, Risk Management Committee, ALM Support Committee, Information Security Committee, Issuance and Allotment Committee, IT Steering Committee, Investment and Credit Committee, IT Strategy Committee. And there could be many other committees as well coming out from a different requirements under the master directions from the RBI. So like as we know, there has to be nomination and remuneration committee as well, which is not here. So if it has been applicable on the NBFC from the Companies Act perspective or not, they are required to follow that.
Yeah, as you rightly said here, go back on the earlier slide.
Yeah.
Here she has put almost all the committees. But all these committees will not be required for all the companies because much will depend upon the type of the business the company is actually doing it. Suppose when you are saying IT strategy committee or IT sharing committee or insurance allotment committee, etc., another thing and all, you have to actually check, verify what is called. But however, in addition to the risk management committee, which is actually required for all the levels, audit committee, remuneration committee, ALM committee, these are all will be definitely called for at all the levels. And of course, one more thing is there under the company side, the CSR committee that also will be called for actually, though not under the RBI, But under the CSR, if it is fulfilling the conditions of Section 135 of the Companies Act, then CSR committee also will be called for. Yeah.
So for the audit committees, NBFCs are required to constitute audit committee consisting of not less than 3 members of its board of directors. And the audit committees will require to act in accordance with the written mandate from the board, which includes recommendation for appointment, remuneration, and terms of appointment of auditors, review and monitoring of auditors' independence, performance, and the effectiveness of the audit process, examination of financial statements and the auditor's report, approval or subsequent modification of the related party transaction. Also, audit committee shall ensure that the information system audit of the NBFC's internal system and processes is conducted at least once every 2 years to assess and mitigate operational risk. Here, in case the audit committee is applicable on the NBFC from the Companies Act perspective or LOTR, then the particular NBFC is required to follow all the laws and whatever is the stringent is required to be followed, covering these requirements as well. Similarly, nomination and
In
remuneration.
the previous slide, just want to add one thing. RBI has a very distinct, though not given in the guidelines, but RBI, when they come for inspection and audit, they see who are the invitees in the audit committee, and they generally, they don't like managing directors or management to be part of as an invitee of the audit committee. They would make a remark in their report that a managing director should not attend the audit committee. But though they may be right somewhere, but somewhere, if all, because most of the members of audit committee are independent directors, if they have any questions, it is a management who would be responding to their queries. But RBI wants that audit committee should be generally discussing freely without the presence of management. That is what RBI has recently come out with many observations. Many companies, they have observed this.
Hemant, one more question comes into my mind. When you talk about the audit committee, the requirement out of the company side, it says that it should be consisting of the independent directors. And the private limited company, when it comes to the committee requirement, is not there under the company side. But under the NBFC, when it comes to the audit committee requirement is there. So does it mean that we need to also appoint an independent director in order to fulfill the audit committee requirement in the private company, if it is a NBFC company?
No, sir. They have clarified that if it is as per Companies Act, you can form the audit committee. They have clarified in SBR.
Okay, so that means the company side exemption is actually available where the independent directors are required to be appointed. They need not appoint.
Correct, sir.
Yeah. Okay, go ahead, sir.
And one more point. Just want to highlight that with respect to audit committee, as per the Companies Act and as per the RBI guidelines. So if you just have gone through the regulation 94.1 and 94.2 NRC and audit committee, wherein you will find that for NRC, RBI regulations talk about that which shall have a composition, power, function, and duties as laid down under Section 178. The word constitution is here. And in the audit committee, RBI doesn't say so. It only talks about NBFC shall constitute an audit committee consists of not less than 3 members, and it can be like have a power, function, duties as laid out under section under the Companies Act. So constitution word plays a major role over here. That how you can form the committee with who all are the members.
But one more thing is there, maybe voluntarily if the private company wants to appoint the independent director, there is no bar in appointing the independent director. But however, once you appoint the independent director, then you have to follow the Companies Act, whatever the requirement under Section 149, fulfilling the various criteria which are applicable to the independent directors. Yeah. Yes, Sakshi, go ahead.
So the other committee is Nomination and Remuneration Committee. So as per SBR, it has been given that it must have at least 3 non-executive directors. At least half must be independent directors, and the chairperson of the company may be member but shall not chair the NRC. And the key functions of the NRC would be identification and recommendation identify the persons qualified for appointment as directors and in senior management, recommend their appointment or removal to the board. They'll specify the manner for effective evaluation of the board, committees, and individual directors. And the evaluation could be carried out by the board, NRC, or any other independent external agency. They will review implementation and compliance of the evaluation process. Now, as we have discussed about the committees, there are several policies which are required to be formed by the NBFCs, as been given in the different regulations and the requirements at different places. So I've tried to collate some policies which have been there, which has been there for all the NBFCs in general. However, if you go to a different master directions and a different requirements, there would be additional policies for sure. And then we'll be covering all of that in our upcoming webinars. Whenever we'll be going into details of those particular master directions. First is the KYC policy, which is very important. Any investment policy, lending and demand call loan policy, fair practices code, which is coming out of scale-based regulations, we'll be covering in our next webinar. But it is a very important code to have in a NBFC, irrespective of their size or asset. All NBFCs are required to have this fair practice code in English and the vernacular languages. Then interest rate policies, risk management policy, expected credit loss policy, ICAP policy, and so many of these. As per the certain policies are not applicable as per their thresholds as well, as we'll be discussing it in the later sessions. So then there is a requirement of appointment of a CRO, Chief Risk Officer, in the middle layer NBFCs. However, it is mandatory for NBFCs having asset size more than 5,000 crores. So if NBFC is in a middle layer, but having an asset size of less than 5,000 crores, so the appointment of CRO is not mandatory on them. And similarly, the required policy for that is also not mandatory. Along with that, NBFC, ICC, IFC, MFI, factors, and IDF NBFCs are required to have a CRO. So who will be the CRO and what would be its tenure has been given by RBI, that it should be a senior official with relevant professional qualifications and experiences. It must be appointed for a fixed tenure with the board approval. And if there is a premature transfer or a removal, it requires board approval again and should be reported to RBI. And if the NBFC is a listed NBFC, any of the changes must be reported to the stock exchanges as well. And it has also described that the CRO must function independently and no business targets or dual responsibility should be given to the CRO. As RBI says, no dual hatting is allowed. And there shall not be any reporting relationship. So because it has said that any business targets is not required to be given to CRO. So it cannot also have a reporting relationships with the business verticals. So RBI has again given the reporting structure as well, that it can directly, so CRO can directly report to MD and CEO or the risk management committee of the board. And if it is he or she is reporting to the MD and CEO, then once our risk management committee or the board of directors should meet the CRO quarterly without MD and CEO presence. The responsibilities of CRO shall majorly he should be involved in identification, measurement, and mitigation of all material risks. All credit products must be vetted by CRO from a risk perspective. Role in credit proposal and advisory only unless part of a credit sanctioning committee. Credit committee role will include that if CRO has a voting rights in high value credit sanctioning, and all committee members are individually and severally liable, including for risk considerations. Then the NBFCs are required to have a fit and proper criteria for their directors. First, that includes the due diligence process, that they are required to do the due diligence suitably based on the qualification, technical expertise, track record, integrity, and other fit and proper criteria must be done at the time of appointment or renewal of the appointment of the directors. A declaration shall be taken from the directors before appointment, which is a fit and proper declaration as well, and a deed of covenants, which has been given in the appendix of the scale-based regulations, and an annual declaration as on 31st March, confirming to the fact that there has been no change in their status as on the previous year, and if there is any updates, they should be disclosing the same as well.
Yeah, meticulously annual declaration is required to be submitted as soon as you begin the year. Otherwise, you will end up with a serious problem. Yeah.
So RBI has, sir, clarified that declaration has to be as on 31st March, not as on 1st April.
Correct. That is right. 31st March only. That means before that only that should be in place. Before you start the year only, it should be in place.
Yeah.
That is the thing. Yeah.
So the role of NRC committee is also there, that it must scrutinize declaration and assess the suitability of the individual. And the final decision on appointment lies with the NRC based on the due diligence. After that, board must ensure that the deed of covenants are executed by all directors in the format prescribed in the scale-based regulations. Then NBFCs are also required to have key managerial personnel, KMPs, as given under Section 2, subsection 51 of the Companies Act 2013, wherein KMP includes any CEO or the managing director or the manager, company secretary, whole-time director, CFO, or any other officer not more than one level below the directors who is in the whole-time employment designated as a KMP or by the board, and any such other officer as may be prescribed. So RBI also uses the same definitions of the KMP for the NBFCs as in the Companies Act. So the KMPs of NBFCs middle layer and upper layer cannot hold office, including directorship, in any other NBFCs middle layer and upper layer except its subsidiary. However, they can hold directorships in the base layers NBFCs. So NBFCs are also required to have guidelines on the compensation of the KMPs and the senior management in the NBFCs. So generally we have the remuneration policy, which is a board approved remuneration or a compensation policy. So in addition to that, they are required to have these particular requirements in those policies as well. First, they have to have a remuneration committee's constitution. They should clearly define the principle for the fixed and the variable pay structures and the malus and clawback provisions. Also, the board must define roles of various committees, especially the NRC, and the guidelines are broad and indicative. NBFCs and NRC ensure compliance with all the other applicable laws and directions. Now, to have independent directors in the NBFCs, middle layer NBFCs are required to have independent directors. So, independent directors can be on the board of maximum 3 NBFCs. Only middle layer or upper layer would be calculated for that directorships. And the board is required to ensure that there is no conflict of interest due to such multiple directorships of those independent directors. And there is no restrictions applicable on the directorships in the base layer NBFCs. And if there is any restriction in the Companies Act, that needs to be followed separately. Now, the additional guidelines for the NBFCs in the upper layer. So upper layer NBFCs are required to comply with all those guidelines, but they have to also follow 2 additional guidelines, which is relating to the qualification of the board members in the NBFCs. So board members in the NBFCs must be competent to manage the NBFC's affairs. Board should have a mix of educational qualifications and a relevant experience, which includes the diversified board, and the specific expertise of members is also required based on the nature of NBFC's business. Also, the listing and disclosure requirement of NBFCs in the upper layer. It has been mandated by RBI that an NBFC in the upper layer must mandatorily be listed within 3 years of being identified as an NBFC in the upper layer. Also, the disclosure requirements similar to those of listed companies must be implemented even before the listing based on the board approved policies. So the NBFCs in the upper layers are more or less is equivalent to the listed NBFCs. Now there is a requirement for appointment of the statutory auditors in the NBFCs. So we'll be discussing that as well, that their RBI has given the different requirements. If the entities or NBFC with the asset size below 15,000 crores, so they can appoint minimum at least one audit firm, which would be partnership or an LLP for conducting the statutory audit. However, if the entities, I mean the NBFCs with the asset size of 15,000 crore or more, then those NBFCs shall mandatorily appoint joint auditors. Only one auditor will not be enough for them. And those should be comprising of at least two audit firms, which would be either partnership or a limited liability partnerships. So, and it is also very important for the joint auditors of the entity that they do not have common partners and they are not under the same network of audit firms. And the NBFC, in consultation with the joint central auditors or statutory auditors, shall finalize the allocation of audit work to ensure clarity and efficiency in the audit execution. Now, the how to determine the number of statutory auditors required in the NBFC. So RBI has also given a proper, based on the board or a local management committees approved policy, they should decide on the number of statutory auditors. But the factors which needs to be considered are their asset size and spread, number of accounting administrative units, transaction complexity, level of computerization, availability of independent audit inputs, and financial reporting risk. So the actual number of statutory auditors to be appointed will be decided by their respective board or the local management committee, but subject to the following limits, which has been given by the RBI. So in case, as on the 31st March of the previous year, if the asset size of a company is above 15,000 crore, then the minimum minimum number of partners, full-time partners associated with the firm should be for 3 years, should be 5. And out of those minimum number of partners, the fellow chartered accountants associated with that particular audit firms for at least 3 years should be 4. So the minimum, and then the third requirement would be the minimum number of full-time partners with the CAs, with the qualification or with the CA, CEI, SA or ISA should be at least 2. And the minimum number of years of audit experience of the firm shall be at least 15. And the minimum number of professional staff should be 18. So for the NBFCs having asset size of 15,000 crore or more, should have the audit firms which has to be at least 15 years old and has to be a bigger audit firm. They cannot appoint anyone there. And then the NBFC,
if the limit changes in between the year, in the middle of the year, whatever the size you are given, because you have put as 31st March.
Suppose of the previous year, sir.
Yeah, correct.
It is on the basis of the previous year. So it would be considered on the next year.
Okay, so
as on 31st March.
If the middle of the year it is there, the existing auditors will continue.
Yeah. So
there is no
because
need,
it has been clarified. Yeah.
There is no need to change. Yeah. Hemant, you want to say something?
No, I agree, sir, what Sakshi is saying.
Okay. So that means even if any changes take place in the middle of the year, the existing auditor will continue. The effective will be only the next year.
Yes, sir.
Yeah.
And to ensure this compliance, just to add one thing, we can have a eligibility certificate from the CM. Usually we are taking it, but to be like having the declaration in a form of declaration that you are ensuring this thing. Yeah. Continue.
Yeah, that declaration anyway will be called under the even the Companies Act also when you appoint the statutory auditors. Because again, the companies are again, under the incorporation, they need to have it anyway. That is it. Yeah.
So similarly for the NBFCs having asset size of more than 1,000 crore, but up to 15,000 crores. So their full-time partners are, which are associated with the firm for at least 3 years, should be at least 3. and then out of those full-time partners, the FCA shall be at least 2, and the minimum partners with the CAs having a degree shall be 1, and minimum number of years of audit experience of that firm was also required to be having 8 years of experience, with minimum at least 12 number of professional staff. And again, up to 1,000 crores NBFCs, the similar kind of limit has been given here. Okay. So these requirements are need to be followed by all NBFCs. However, one thing is there that we need to see that as the NBFCs are required to follow stringent norms, even the audited firms should be very renowned ones, or very whosoever are in the business for a very longer period, so they know the responsibilities both ways for the auditors as well and the company sides. So there is also
So
requirement.
one practical thing, RBI directly calls auditors also. They have separate meetings with auditors. They understand from the auditors about NBFCs. So and they have recently, I mean, for many NBFCs, while going for the inspection, they check, how did you review the auditor's performance. So that is also to be documented very properly. So we may, generally what happens is we appoint them for 3 years and they are eligible. They give eligibility certificate and all. But RBI insists that, eligibility certificate is not only the requirement. How did you review their performance? What is the background? What is the thing that you placed to the audit committee? That is also to be documented properly.
So the tenure and rotation of statutory auditors has been given by RBI, that the statutory auditors shall be appointed for a continuous period of at least 3 years, subject to annual eligibility. So their eligibility will be checked every year. If they are not eligible, they will not continue for the next term, though it would be less than for the 3 years as well. So if the company wants to remove the auditors, they require in the case of banks and UCBs, a prior RBI approval is required. And in the case of NBFCs, RBI SSM RO is required to be informed with the reason within 1 month if any auditor has been removed during their term. There has to be a cooling off period after a full or a partial term of the audit firm is completed. The firm is ineligible for reappointment in the same entity for the 6 years. That is 2 tenures. That cooling off period is required to be followed. And however, those audit firm can audit other entities during during the period. There is also a requirement of, there is a restriction on the audit firm as well to have a audit of NBFCs or the banks. So in a year, audit firm can take 4 commercial banks maximum, including maximum 1 PSB or 1 AIFI RBI, 8 UCBs or 8 NBFCs. And those other statutory caps and eligibility is required to be followed for these. The other condition is also that the firms with the common partners or the same networks are treated as one entity. So they cannot be treated as 2 different entities. If there are joint partners and they belong to the same network, they cannot be part of a joint auditors. If there is a shared or a subcontracted audits, that is not permitted by an audit firm shall associated with the outgoing auditor will be considered as a part of a same network and will not be eligible for the reappointment.
I would like to ask one question to both the panelists. When you are actually looking at the Companies Act actually says the auditor's appointment is actually for the period of 5 years. But when we look at that RBI, it says that the statutory auditors in the non-banking finance company required to 3 years only. And again, they are also talking about. Don't you think there is actually a departure of this in the RBI when compared to the Companies Act?
Yes, sir. There is this thing, and a lot of representation was made to RBI, but then RBI has continued with the requirement. They only want for 3 years. And I'll tell you what practical challenge group companies faces. Because of this, many companies, where there is an auditor, for example, a holding company's auditor, or other companies. So they have to consolidate, the audit, the financials, and they have to review the audit committee. They have to review the financials of other subsidiaries also while consolidation. So for them, there is a requirement for internal policies. All these big fours, that at least 70% of the work should be with them. So they should be doing the group consolidation. Then only they can give a fairness opinion. So what happens is, we find it. I mean, we have to replace though this auditors, every 3 years also for the holding company because of this reason.
Yeah, that is what I'm actually coming to, because there seems to be, basically a departure between the company side to the RBI Act, which will create as you rightly point out, the practical problems actually. Yeah. Anyway, we'll have to live with it. As you rightly say, there have been representation. I'm also aware of it, but nothing has come for so far. Yeah.
So now we move to the last section of our presentation, which is our case law. So we'll be discussing
I
a
think,
case law.
Sakshi, before we take the case laws, can we continue with the questions? Yeah.
So this is the last part, and then we can take up the questions.
Okay. How many slides are there?
Only 2.
Okay.
Yeah. So we all know there has been a IL&FS crisis in 2018, which
One of the failure NBFC, yeah?
so which has been considered as a turning point for NBFC regulation. So we'll be discussing that in brief. So to give a background, infrastructure leasing and financial services, which is IL&FS, it was a major NBFC of our country, which was operating across multiple sectors, be it infrastructure, financial services. However, in 2018, IL&FS and its subsidiaries defaulted on repayments of worth rupees 91,000 crores. And those defaults led to the liquidity crisis across India's NBFC sectors, which triggered panic in the financial market. Then the legal action was taken that the government of India filed a petition before NCLT under Section 241 and 242 of the Companies Act 2013. And it sought to replace the IL&FS board to prevent mismanagement and protect public interest. The NCLT allowed the government to take over the management, and the Supreme Court later intervened to grant a moratorium on legal proceedings against the IL&FS and its subsidiaries to ensure a smooth resolution. Here, the key legal issues were that it was a corporate governance failure. They misused layered subsidiaries. Systematic risk and a public interest was at stake. And the regulator was also not aware of all these things, be it SEBI, RBI, or NCA at that point in time when these things were happening. So it was a failure on all those sides. But it has a major impact, and it was a very relevant case to understand the importance of these regulations when we see that RBI has a very stringent regulations, which is coming from those kind of experiences and is for the public interest only. So RBI has prompted a very strict regulations for NBFCs, especially in the asset liability management, disclosure and governance standards, and the risk classifications, which has come in the form of scale-based regulations framework. And also RBI and SEBI has introduced tighter scrutiny over the large NBFCs, and they created the awareness of systematic risk posed by shadow banking. So this is it for today. Now we can take up the questions, sir. Thank you.
Okay, we move on to the questions now. Please share the contact details of the Keshav somebody said in the beginning. Can you please elaborate about the SRO concept? I think they're referring to Keshav, who answered initially SRO concept. Would you like to say something, a few words? Of course, she is going to cover in the future presentation on this elaborately.
Absolutely. Just a brief snip that SRO. Likewise, if you have heard the name FICCI, CII, so they are the representative of the industry. So RBI also want that, since digitally, the way it is coming and evolving or integrating in the system. Likewise, we are using many of the multiple softwares, and everything is digitally converted. So that's how RBI wants that more innovation is to be coming in, and they want to support this innovation. That's why they came up with the idea of creating a self-regulatory organization wherein if you want to running a product which is different from the normal way which it is supposed to. So that's why these organizations will come into picture. Likewise, if I give you the name like DLAI or FinTech Association of India, so these all are SRO, and representation are being given to RBI through them. So let's suppose if you want to give representation on some of the matters wherein, so then individually RBI will not be, you can say, accepting these applications. So by them you can represent and you can get something, you can get the law clarity on the law, seeking clarity and have your own bylaws.
Do we need to keep only a KYC number in our records, or do we need to download the records and to keep the same in our system?
We need to download. Yes. Not
Okay.
only the number we need to intimate it to the customer, but we need to download.
Okay.
Then only the KYC file will be completed. As and when RBI will be coming to check, then they are going to review all the KYCs.
There have been questions asking whether can you change the PPT, etc. Let me tell you one thing, PPT is not actually shared. But however, the recorded webinar is disseminated via the YouTube. You can actually access, all of you can access through the YouTube. Dissemination of information is available and thus contains the PPT. Okay. What is the minimum capital requirement? That I think she put up the slide. She has given the things on this. Okay. I have a query. My company is actually a base layer NBFC, and we are considering amending the object clause to include insurance business, corporate agencies license without affecting the NBFC registration conditions. Could you please confirm whether the amendment requires prior RBI approval or whether MCA approval should be suffice?
Yeah, so for carrying out the insurance agency business, you don't need to apply for the RBI because it is not affecting their things. And definitely you will be applying it to RBI and taking the approval from them.
Okay.
Keshav, I have a very basic question. I mean, I don't understand this. When you say you are a base layer, you don't have a customer interface. When you say you will have go into insurance business, so it will then definitely have a customer interface, right? Though not in NBFC sector, but definitely somewhere, it will have a customer interface.
Yes.
And it would be very difficult, for this company to establish that, the customer interface is not for the NBFCs and all. So you may have to check.
That's a practical challenge, but that will be regulated by IRDAI. But there is no prohibition on taking.
I understand. I'm just guiding this person that you'll have to detail check. Because there are practical issues here.
Yes, you need to have a separate server. Everything needs to be very distinct, so that there should not be any commingling or something like which actually create problem in RBI's mind.
Section 45(1)(f), the infrastructure in the insurance business will be considered the NBFC. Yeah, of course, the insurance business also a NBFC only. There are also NBFC non-deposit taking, and what is a net owned fund for NBFC? I think she has put up the slide for this. She has given all the limits for all the type of the NBFCs, I think.
So minimum net owned fund is at least 10 crores, and then it can be, as per the different categories, it can move to higher requirement as well.
Has the 50% to be checked based on the original value of the assets or revalued value? And the 50% check.
It is the revalued value, sir. What appears in a balance sheet. Okay.
That is as appearing in your balance sheet. That is right. Either chit fund company like Shriram Chit Funds, NBFC, or it should be deal in the owns and deposit or quality as NBFC. What is this question? Either chit company.
He's asking for chit company or an NBFC company. So chit company is regulated by their own state laws. So that's how we can respond to this.
Yeah, chit companies is coming under the state regulation separately. It is not coming under this, I think so. The 3 different NBFCs we are being discussed in future. Okay, that is all right. For increasing the NY, to 10%, we may allot the new partner and given them the more than 50% of the equity. I don't know, he's sharing or he is asking the question. For increasing the NOF for 10%, we may allotment the new partner or give them more than 50% equity.
Yeah, we can, like whatever I have understood is like if they want to increase the net own fund, and net own fund can be increased by infusing the further capital, and it is if it is giving the effect of change more than 26% control. So definitely you need to take the RBI approval and then you can proceed further.
Okay. Whether the non-deposit taking company, that is a registered NBFC, if she wants to manage the small investment company being the holding company under the scheme or arrangement, then which RBI regulations are applicable?
Same, wherein if in case it is coming, you can say breaching the threshold of 26% control change, then you refer to that regulation and you need to take the RBI prior approval.
Which committees are required to be considered in the base layer? I think she talked about it. She gave various layer wise and she has given the committee elaborately on this, I think so. Can we let me know the date and number of the master circular? I think he actually called out the date and master circular. I think Hemant actually shared these things, I think so. Yeah. Is it required to have the various committees in a NBFC in the base level? Yeah, that also she answered. Only the risk management committee will be required. In the other layers, it will be called for it. Kindly give an example of the non-deposit taking NBFC. Infrastructure, we can give an example immediately. Any other things? He's asking kindly give the example of the non-deposit taking NBFC.
So there are multiple. So it's like I can say Indify Capital and all. So that's
Correct.
how I do see lending card is there.
Yeah.
Muthoot is there. So
yeah. Okay. Then next is now there is a scale-based regulation for NBFCs, right? What are the base level NBFCs and how it is actually acquire them? Base layer NBFCs, she has actually explained how to acquire them is your strategic decision. Keshav, any thought on this? What he is asking, how to acquire them?
I think he's asking that how to acquire an NBFC, since everybody like middle layer, since now NBFC has been categorized, somebody has told him that it's a base layer entity, it's a middle layer entity when he is like going to do the inquiry in the market. So that's why he's asking. So you can be like getting in touch with the professionals and they will let you know that how to transfer the shares and take the RBI approval. So there is a due process around it.
Types of NBFCs are the one which can exist academically, or do they really exist?
So it is not academically, it is there. You will find if you do some research and do the Google, then you will find various type of NBFCs. Likewise, we have discussed IL&FS. It's an infrastructure company. Shrey Infra was there. Equipment finance companies are there. Shriram is there, who is actually into the motor vehicle financing. So even Aradhan is there, who is actually doing the agri commodity financing. So but there are multiple NBFCs wherein you will see that. But you definitely examples would be less because retail finance NBFCs are more like Bajaj, Shriram and all. But you will find other NBFCs who are into the other categories.
Somebody is asking a question. Do we really require such a large number of entities?
So that is what we can say, that India is growing, economy is growing. Definitely the credit demand, how the credit demand is fulfilled through NBFCs only. But the NBFCs are the bridge between, you can say, banks and the customer. The role which banks are not able to play going to that tier 1, tier 2, tier 3 cities. So NBFCs are doing so. That is what my take.
Someone is putting a question. What is the customer interface?
So I think Hemant can answer very well on this too, since he has also pointed out. Hemant, if you want to. Yeah.
So where customers are involved, directly, where they can approach NBFCs face to face, so you have customer interface. So where customers are involved. For example, I'll give you an example. There is an investment company. Okay, it is purely into investment. It is not doing any lending. It is just an investment company. It is proprietary investment, no borrowing. It is using its own fund and it is investing for its own. It does not have a customer, so it is not having a customer interface. If you are into lending business, you are lending someone, you have a customer. There is a customer interface then. where customers are involved as customer interface.
There is a very little requirement and guidelines for RMC under the RBI. No,
Yeah.
very.
It's fine. RMC. Okay. I think this
This
is a comment, I think, given by Mr.
Okay.
NG Shak.
Okay. If I understand correctly, the company investing the share is also NBFC. There are large number of such companies which are not actually registered with the RBI. Can you please throw some light on this?
So yeah, if you are actually, if you see, if any company meeting the criteria of 50-50, then they are supposed to go to apply to the RBI for the license. Otherwise, regulator, if they themselves find it out that you are carrying out such activity, then they can take action against you. So those who are doing so, they are, assumption I can take that they do have some other revenue stream as well. If they are doing solely
I think some problem is there. We are not able to hear.
Then so now it's very difficult because of XBRL and all. So if MCA will automatically catch all these things, 50% assets and 50% income, and that company may receive notice any point of time.
I can put it only one way: so long as RBI or so long as regulator doesn't catch, you think there's no problem. The moment RBI, any regulator catches you, then you have a serious problem.
Even when auditor will be signing the balance sheet, they are going to let you know that this is falling under the NBFC and you need to apply for it. So it is not that easy to meet the compliance and the meeting the requirement and you're not applying for the license.
And another thing is there, being the company secretary, we are there, either the employment or the practice or whatever it is, we should properly ensure that the compliance is actually done as and when it is called for, actually, in order to avoid all this litigations, etc.
So practically, what these companies does, sir, when they are purely into investment, they also they ensure that the other 50% test with respect to the income from financial income, they ensure that they have some other fee income like advisory income, and also that 50% income from investment is I mean that test fails. So that is how people do.
Yeah, so long as you don't meet the eligibility criteria, you are well within the law. But the moment the eligibility criteria is actually met, then you have a problem. That is right. That means you know to manage. That is the thing, as you rightly said. Whether it is a strategic planning, whether any concession and discount, rebate, interest for directors, senior officers, whenever the loan is given to them.
So it is at the company's discretion. They do have their credit policies, to whom at whatever rates they want to give it, they can give it, considering in compliance with the company law and the RBI. So company law will be playing a major role in this thing, and RBI doesn't have any discretion to do all these things. But they do have the policy regulations. So yeah.
How to bypass the prior approval of the 100% takeover? I don't think I should answer this question because we are talking about the compliances. We are not here for the non-compliances. Sorry. Can I incorporate the company by trading of the shares and it is recorded NBFC license? Then again, as Keshav puts it, the criteria is to be checked. That is what it is. Because your major income is going to be in this activity, then if it is more than 50%, then it is NBFC. If it is not so, it is like that. That you have to take a call. Nobody can guide you on this because you have to take a call yourself on this. Okay. Somebody is actually saying it's you answered this question. This is the FAT this thing list, which is actually published by the RBI, and it is done in 3 times in a year. It is available on the website actually. Yeah. All these compliances are to be done through the Prava portal.
So Prava portal is for some specific activities. These are not required for filing and things. But if you want to apply for a name change, you want to apply for a management approval and all. So for that, I think you will be using the Prava. But other than that, there is a Daksh, there is a SIMS portal, and so other for filings and all. So things are there.
Does the annual financial budget to be approved by the audit committee or not? Audit committee basically looks into the audit related activities and the auditor services, etc. and all this thing. I think financial budget goes to the board. I don't know why the question is actually like that. I don't think there is any financial budget is actually coming under the audit, because audit related things only will come on the audit committee. Audit committee will have the terms of reference. Yeah. Keshav?
He's talking, might be he is talking about the annual operating plan. But it's a good practice that you are placing it before the audit committee and then placing it to the board. Totally depends on your articles and all. Since if your article says so that you need to have the approval from the audit committee, then only you can place it to the board. Since nominee directors are there, investor directors are there. Depends on the composition. So up to your, you need to go through your articles and bylaws and then come out
Yeah,
with the
that means
conclusion.
that is the company is totally the internal policy, what they
Yes.
have, what is the setup. Yeah.
Yes.
Whether the investor director or non-executive director can be part of the audit committee.
Yeah, absolutely, yes. They can be. So RBI, as per the RBI, since depends on other factors as well, what type of company you are there, like with public, private, listed, unlisted. So depending on that, but if you specifically ask from the RBI point of view, then non-executive director can be the part of the audit committee.
What if we have the 3 independent director appointed, but in our audit committee, there is only 2 independent directors and 1 executive director?
Till the time it is meeting the requirement, it is fine. But the minimum threshold requirements are there, it is fine. I don't see any.
Yeah, you have to see the requirement. That's the thing. All the
Yeah.
ID cannot be audit committee member, but only thing is that criteria you have to check out. The concern of the audit committee is to have the independent director to discuss without interference, absence of the management represented by the managing director, who basically is actually conducting the applications and take the blame for all the activity. I think somebody is putting a comments, I think. Who manages the risk management if CRO is not there?
It depends who has actually assigned with the duty. Chief risk officer is not there, then other officer would be there, and even compliance officer. Sometimes I've seen in many companies that they are actually managing those things. It depends, varies company to company.
This is what the question. Please elaborate what Ivan, Manus, etc.
I think they are referring to clawback thing, wherein RBI master actually say so that you need to have a policy on the clawback, in which circumstances, scenarios you need to like claw back the remuneration and have a provision in case some fraud or some things crop up later on. Then how you going to like take the action? I think it is Basan, I'm not sure of your question, but yeah, malice is something which I can link it to the NRC.
Is it mandatory to give the RMC in the base layer NBFC? Yeah, risk management committee is called for in all the layers. That is the thing. Please elaborate more on bonus, etc.
Yeah, so the same thing, which I'm saying that it totally depends on your company policies, and you can refer the RBI master directions, wherein they are talking about that you need to have a clawback provision in the KMPs and senior employees offer letters and appointment letters, so that in case some things crop up or not moved in, not in the compliance with the law, then action can be taken up. So yeah, it need to sync up with the HR and have a discussion at a board level, wherein what actually how this compensation part should be created and can be clawback in case something's gone wrong.
Need more clarity on, can a statutory firm be appointed as 2 NBFC having falls within the same group?
I don't see there is any prohibition to this thing. Auditor can be, till the time it is meeting the maximum number of companies, then it is fine.
Professional staff include both CA and intermediaries?
I don't know in which context this question has been asked, but
no, he is asking. So 12 professional qualified people will be there in the size of the firm. What you are talking about? There he is asking. So he says whether professional can be a CA or it can be intermediates also. That means not qualified people.
So not qualified will not be considered, considering numbers are for qualified only. The size could be anything. If we start including intermediaries, then there would be a whole list of people which I think can be.
One thing we'll have to understand, when we say professional, it is fully qualified. There is no question of half qualified. That is the thing. Yeah. Okay. It may be a policy decision that government companies, all the auditors are appointed for the maximum period of 3 years only. Yeah, could be government will have the different thing which we cannot comment because government will have their own regulations, their own governance practices, etc. Other things around. Can you put some light on Takesh portal of
Daksh
NBFC?
portal.
Daksh
Huh,
portal,
so
yeah.
yeah, so this is a portal which is like recently implemented by RBI to centralize all the compliances. But they want to control, having, you can say, centralized control for all the affairs, all the working of the NBFC's company. So that's why they have introduced it, and you can see that frequently multiple guidelines are being issued on that portal, and you need to sometimes give the affirmation that you are in compliance with or whatever your approach is. So that's how RBI wants to have that centralized portal to ensure compliance. Likewise, what actually intent is to reduce the paperwork. Likewise, we are doing sending the letter to the RBI that we are meeting the compliance with the fair practice. We are meeting the 26%. There is no change in auditor. So all these things RBI wants to have an online thing, and central repository would be there. So whatever communication would be there, you can also trace on click, and they are also, but they from their end as well, they would be very easy to trace that whatever activity you are doing. So it is a centrally managed thing.
So more towards digitalization. Huh? Can you please clarify whether in case of the change of the management, the director of the criteria 26% or 30% as on financial year or at the any time during the period? I think it's the end of the year. He said actually 31st March in the previous year. That's what the slide has been put. It has
I
been
think
also clear.
30.
Yeah.
See, to my understanding, 26% and 30% is like depend. Totally, 26% depends on the control, wherein if there are any change in the shareholding, and it can be done on any point of time. But we can't say that on 31st March let's suppose if you have changed the shareholding on 1st April and then again on 31st March you came back to a status quo. So it is not the intent. It is that whenever there is a change more than 26% from the last change, then you need to take the approval. Same goes to for 30% change as well. Wherever change in the director, you need to consider the last one and then apply it to the RBI.
Will the RBI come up with the streamlining of the updates they publish, or they identify the updates unlike SEBI updates?
So I think Dutch portal is there. Definitely RBI is coming up with circulars and everything. They are giving guidance and things through portals only. So later or sooner you will see that everything would be like merged into the one portal, and I think it will work like SEBI also as well.
What are the committee mandatory for the base layer? I think RMC committee we discussed time again. Do we recall query approval of the RBI for merger of the NBFC company with the SEBI registered stock broker company before filing the petition before the NCLT?
So approval from the regulator is required. In case you have been regulated by some regulators, it could be IRDA, it could be RBI, it could be SEBI. So definitely you need to take the approval. Then only NCLT will be like approving the same.
Yeah, in fact, NCLT will not consider under the prior approval because when we went for the merger and amalgamation for the companies, they specifically have the RBI approval for the NBFC companies. So otherwise they won't consider the application. Otherwise they'll keep the application pending. Okay, whether the base layer NBFC are getting transfer orders from RBI these days? I'm not getting the question. What is this transfer orders? Whether the base layer NBFCs are getting transfer orders from RBI these days?
Transfer orders, to would not say, but they might be saying transitions. You need to follow some stringent guidelines. Might be that would be the thing.
Okay. Sir, if a NBFC having a less than rupees 10 crores and net and own funds, then whether the NBFC is mandatory, whether the RMC is mandatory for such NBFCs?
Absolutely, as it is falling under the base layer, so definitely.
RMC will be up for all the levels, na? That's
Yes.
what she said actually in the slide. Requesting you to organize the webinar as the information security aspects of the KYC. Yeah, okay, your suggestion is taken. Definitely, we will consider this. Good suggestion. Okay. Should we appoint the auditor for the period of 3 years instead of 5 years in case of the base layer NBFC company?
Up to the company's approach, and auditor's comfort. But the max limit as per Companies Act is 5 years, and RBI usually put the obligation on the middle year. So at base layer, it's up to you. You want to appoint it for 1 year, 3 year, or 5 years.
It is between you and the auditor because the problem
Yes.
is the moment you appoint 3 years, under the expiry of 3 years, one term gets over.
Yes.
It is actually considered the own term.
Then you need to follow the cooling off period and
that is the
everything.
issue. Then automatically, if you have a 3 years of 2 time, then your 2 time term is getting over, then cooling off period will come into place. Can someone become the NBFC MFI within 10 to 20 crores of capital?
So till the time you are meeting the minimum capital requirement and having the license from the RBI, so you can be then NBFC MFI.
BIMO's platform is for what type of a NBFC? What is the function? Please elaborate.
No, not sure of. I think this is some. He is referring to some portal likewise who are doing digital lending kind of a thing. Might be some software provider, SaaS company. Not sure of.
What is the role of the SRO which needs to be submitted within them? That I talked about it. He said actually SRO, he elaborated well.
Yes. And just to add, just to give him the specific answer, that SRO will be taking the data from you, that how many customer complaints are there. Just to give the example, how many customer complaints are there, how many, you can say, interactions with the regulators are there. So they are actually acting as a data repository to come out with some good conclusions and to represent all other NBFCs. Yeah.
What is the legal protection available for the gullible investors in the companies which are not registered or classified as NBFCs? We hear a lot of cases of late about such companies.
So there are various portals. RBI has actually given such a portal is there wherein you can complain. SEBI has issued the score portal and consumer forum is also there. So you can have various remedies, and definitely you need to be vigilant first. That's the whole thing before doing anything. Yeah, you need to study well and do research. Yeah.
If the process is taking over the NBFC, if one actually existing director or transfer promoter is continue and other 2 new directors, including one independent director, are proposed to be inducted without having taking the NBFC's experience, will it actually fulfill the criteria for condition of the RBI with regard to the board constitution or takeover practices?
So, see, RBI will be taking fit and proper criteria. They are also going to see the credentials. They are going to do the verification, background verification check of the directors. And definitely, if they do have the apprehension, they will come back with the reservations or comments to you.
Even a small private company, 5 friends coming and doing the investment, only say 1 crore, need to register the NBFC or 80% of the income from the investment?
The same, if you are meeting the requirement, if you are you can say meeting the 50-50 criteria which is prescribed by the RBI, definitely you need to.
Yeah, because he says 80%. So that means definitely you are meeting the requirement. So you need to register.
Assets needs to be 80% from that 50% income. So definitely, we can't, I don't want to comment on this thing, but yeah, definitely your auditor and you need to discuss and having a professional advice onto this piece. So, but yeah, that's a generic answer.
Correct. You have to check the eligibility criteria. That is very clear, because here what we are discussing, we are not answering the specific question pertaining to the particular problem. We are just discussing the general. So you have to apply the eligibility criteria as Keshav puts it very clearly. Do we need to keep only the case in our, this I think you answered earlier, we asked that question. We applied for the login and the password sanction in the Parva portal almost 1 month before the response from RBI should be action or appeal to be adopted in getting the login.
Would suggest to visit the office, wherever your RBI office jurisdiction coming in, and you can visit and you can get your things sorted over there. They will help you out, definitely.
Again, the KFC
you can take help of your SSM also for this.
In fact, the KFC question has come, you have to download and keep it. That's what he answered actually. If the bank balance on the current account and the FD will be actually considered as a financial assets or calculating a 50% financial assets.
Yeah, so depends. So cash is there, and it's a very how the auditor will be taking this as in their accounts. So you need to consult it with your auditors regarding the treatment of the same.
BIOM platform, that's what you also raise. The private portal, I don't think we'll be able to answer that question actually. Yeah, I think with this we have come to the
As I can see, BIOM, it's a Union Bank of India's app, and they are actually promoting it. They are doing it for lending, for providing other facilities to the retailers. So it is a bank's product, bank's app. So that is what I can see on the Google, and nothing related to RBI and sort of a thing.
That's all. I think we have come to the end of the questions. I will see whether anybody has risen the hand actually. I don't see anybody has risen the hand. Anybody would like to ask any question here? Anyone? If that's the case, you can actually raise your hands. We can permit you to ask. There are two hands are raised actually. Magesh, you can actually unmute. You can put up your question, please. Magesh is on, Biraj is on. Any one of you can unmute,
Hello,
please.
good afternoon, sir.
Yeah. Yes, Magesh. Go ahead.
This is Mahesh, sir. Actually, recently, one of my client wanted to acquire an base layer NBFC, which hasn't registered office in Jammu and Kashmir. He acquired a stake of 25%, and we applied for the to the RBI for change of control. But consistently, RBI giving different queries each time. Any specific reason RBI is reluctant to give the approval, sir?
So Mahesh, see, again, it is coming on to the profile of the person who is actually acquiring this NBFC. As talked about this thing in the webinar, that RBI is very much particular who is running the NBFC, who are the people who is actually running the show, and they want to have literate, you can say, educated people, wherein that's why they are coming up with the requirement that you need to have independent director who is actually having a financial background. Even shareholders, they are seeing that who are the shareholders who actually have the background of running a NBFC business, because it involves public money and they don't want to take a risk. That's why they are coming up with the queries and again that to check the background and all. But definitely your I would say the approach would be that to resolve as much as possible, to get in touch with them, have a face-to-face meeting to understand how these things can be done quickly, and any other issues if they do foresee, then you can just have a discussion with them onto this approach. That would be my suggestion.
Yeah, one-to-one discussion always help, and RBI is really helpful actually. Yeah. Yes, Biraj, you can unmute and talk.
Yeah. So this is Biraj Pancholi from Empower Microfinance. See, my question is in that guidelines for the appointment of statutory auditors, it is stated that the company below 1,000 crore asset size may follow the extent procedure. I mean, that's in my understanding is extent procedure will be the Companies Act. So my understanding for the NBFC below 1,000 crore, obviously we have to follow Companies Act, but do we again need to follow that RBI circular on appointment of auditors, or we should not give any reference to it?
So you should not, but see, it's depend on how you draft the things, and since it is coming under the below 1,000, so option is given to you whether you want to follow the stringent compliance or you want to follow the current one. So up to you and your company's practices, and Sakshi or sir, if they want to add something onto this.
In fact, according to me, whichever the stringent procedure, that has to be adopted.
Yes.
Because
and
you cannot discuss it.
Yes.
Because option is not this one or this one. Because both are applicable, you have to comply with both, and naturally the stringent one will be applicable. That is the thing. Yeah. I think that is all. We have come to the end of the discussions. It is almost 1:15 or something. It is really a very good sessions. Lot of participants, elaborate discussions. And in fact, Sakshi has very nicely put up the presentations, and both the panelists have shared their experiences, and they have actually shared a lot of things, practical insight, etc. What are the things, etc. I'm really thankful, both of you, Hemant and Keshav. Thanks a lot. With this, we close the session for this week. We'll get meet next week in the next series, second session of the NPS. Thanks a lot. Thank you. Thank you all.
Thank you, everyone. Thank you for joining the session. Bye.
Thank you, everyone.
Thank you.